Paul Merriman shares 12 $1 million ideas that you need to understand for financial success. Here we go. Welcome to the Forget About Money podcast, where we encourage you to take action today so that you can focus on what matters most to you. Today's guest, Paul Merriman, is a renowned expert in personal finance and investing. He started his financial career in the 1960s as a broker on Wall Street, then transitioned to helping small businesses raise venture capital. In the early 1980s, he founded his own advisory firm and became a leading advocate for passive index fund investing, asset allocation, and long-term strategies like buy and hold. In 2012, Paul founded the Merriman Financial Education Foundation, dedicated to providing financial education to help investors make informed decisions for their retirement. He is also the author of several popular books, including Financial Fitness Forever, 101 Investment Decisions Guaranteed to Change Your Financial Future, and frequently contributes to MarketWatch. Mr. Paul Merriman, it is always a pleasure to be in your company. Welcome.
Hey, David, it's great to be with you and your folks. Absolutely.
Paul, today we are going to be discussing your 12 $1 million ideas for investing success. These are found in one of your most recent works with Richard Buck. It is a book titled We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. Paul, your work has helped so many people build wealth. Can you give us a brief overview of what inspired you to create this list and why these concepts are so important?
Well, the list was created in the hopes that as I am in the process of ending my life, I'm not working on it this week necessarily, but in the coming years, I wanted to leave some work that I believed would have an impact on investors. In some cases, I would like to think for the rest of their lives. And as you know, the work that we do with our nonprofit foundation is all about education. And the bottom line is investing theoretically is very, very simple. And what I want to make sure is not only that people understand that it's simple, but that the impact from little steps can absolutely be huge over a lifetime. And so that was what the book was meant to be able to help people see. And we've offered it free so that people, if they'd like it, can turn around and send the PDF to family members and friends and fellow workers. So it's an attempt to reach as many people as we can and improve their ability to be a better do-it-yourself investor. That's the goal.
Paul, thank you so much. And just in your voice, I can hear the passion that you have for helping others. We will include that link to how people can get that free book in the show notes. I know one of your goals is to simplify investing for the average person and helping them avoid costly mistakes along the way so that they can build wealth efficiently.
Yep.
And these 12 ideas are the distillation of proven investment principles anyone can follow to achieve financial independence. The very first idea that you have is save versus spend. Save some money instead of spending it all. When it comes to the debate of saving versus spend, how do you advise people to strike the right balance, and what impact does consistent saving have on building wealth over time?
Well, I think the first thing that we have to understand as a young investor, is that most of the system, the capitalistic system here, is really about how to get you to spend. And so it's not like you've got a big team of people on your side trying to get you to do the right thing. And in fact, if we can just arm wrestle those people who have become so efficient at putting our money to work someplace else, and even if we're not saving, they still want us to go further and use a charge card to spend more. So it is a real fight that the individual has. And the bottom line is the really wise words of Warren Buffett about the step that should be taken, and that is, don't save what's left over after spending, but spend what's left over after saving. And we know what that's about. That's about paying ourselves first. And successful investing is almost always going to be about some level of discipline. And I would say the toughest one of all is to save, but remembering that saving is really about spending, but doing it later. And so my sense is that if we can just get on an automated course, maybe, for example, all you can afford is 3% at this point, great, do the 3%. But part of your commitment should be raise that to 4% the next year and 5% the year after. We want to get you up to 10 to 15% as soon as possible. But when you think about the goal of making an extra $1 million with these 12 decisions, this one is so easy to understand because you don't have a chance if you don't do some saving. And then, of course, the main point after that really is about making sure that we save it in the right place. And really, we're talking then about investing.
So with saving, let's say a person is just out of college or just joining the workforce. What can they do to start saving, and where do they save?
Well, this is, of course, the big challenge, and that is to create a plan. And since my work is not sitting down with people one by one and helping them work through this, the bottom line is that they have a lot of things they need to take care of as they start in their career. And of course, they're just sitting there thinking, look, I put up with my lousy parents for 18 years to get out of the house. And then I get out of the house, but I still don't have anything because I got to go to school for 4 or 5 years. I have had now 18 plus 4 years of sacrifice. Now I'm going to finally make some money. And now I can start to enjoy that money. And somehow inside of our brain, we have just got to understand that as much fun as it is to enjoy that if we don't package a little commitment to that saving, that the enjoyment can go on forever. And by the way, most people in this country at age 50 don't have any savings of significance. So it's not like it's a rare case where people aren't saving. It's just the opposite. Too many people aren't saving. So what you need to do is to have a budget. And maybe you've already developed that. I know at Western Washington University, where we have a course for students there, one of the things we want to be able to teach a freshman is about budgeting, because budgeting is something that if you want to increase the probability of a student making it through college, they need to make sure they make the money last. So budgeting doesn't have to be a whole new process. They may already have that exposure by the time they graduate. But it's just a matter of controlling your spending. That's it. And when I say that's it, I always have to remember that I fought not the saving hurdle in my life. What I fought was the eating hurdle. And in many ways, it's not so different from my struggles with not eating properly, because I just love to eat. And it's the same with enjoying that money. It is fun to enjoy that money. And you just got to realize that for later, the life that I enjoy today comes because I was willing to put money aside early. And that's the vision that we need people to see. And you do need to, I think, David, you do need to see that down the line. And we're going to talk here today maybe about some decisions that people might make 40, 50 years from now. And yet, if you see that as a part of the total plan, you can see how these decisions become individual $1 million decisions along the way. I hope we'll have the time to do that. And if I don't stop talking, I suspect we won't. But it is finding the discipline to do it.
Yeah, and it's tough to find the discipline to do it when there are so many blinking signs that say, buy this. I mean, we're at all-time highs for credit card debt.
Yeah.
I don't know if it's society for sure, as a world, maybe, I don't know. But I know in America, we're at all-time highs for credit card debt. And then the next step after that is, which is gaining popularity, is the buy now, pay later services that are growing in popularity. And many argue that they encourage overspending, which undermines the saving habit. But other people argue, it's like YOLO, you only live once. And, there's been so many bailouts in the past at the corporate and individual level that, why worry about it? But I'm a big believer in control the things that we can control, which is our spending. Yeah. And for me, whenever I'm trying to convey saving versus spending to people, it's the hurdle that I have to get over to help them understand is the whole delayed gratification piece. And it seems like as time goes by, that's more and more challenging to overcome when trying to convince somebody to save versus spend.
Well, and I think that the challenge becomes greater because even if they have a sense of needing to save, they don't understand how important building that small foundation is in the whole process. As a matter of fact, one of the other $1 million decisions is to start saving as early, number two.
That's the number two. We're rolling right along.
As early as possible. This is a relationship, that you're about to create, a business, a partnership. Because as you start putting money away, and we're hoping that you're going to put a significant amount of that into the stock market, and we'll talk about that and why that's so important. But what we need to understand is this fortune that you're about to build, and it literally could be a fortune in terms of the $5, $10, $15 million, is all easily possible if you get this discipline early. But that the foundation that you create in this business, you see, you could put away $1,000 the first year, $83.33 a month. At the end of the year, you put away $1,000, and you've put it into the stock market. And the stock market doesn't have a very good year. And at the end of the year, your portfolio is worth $1,022. In other words, you, as the senior partner, put in the $1,000. Mr. or Mrs. Market, whatever you want to call it, your partner offered $22 to build this fortune. And it stays like this for the first 10 or 15 years of the process, that it is your money that is building this base that is all important. Then all of a sudden, you're going to wake up and you're going to see something marvelous. And that is, you're putting in, if you increase how much you put in every year, maybe you're not putting in 1,000, you're putting in 13 or 14 or 1,500, but the market is making 3, 4, 5 times that. And when you finally get to that point where your commitment to building the foundation is overtaken by the growth of the market, and I can almost guarantee you that if you do this with modest amounts of money, later in your life, you will have years that you make $100,000 and more. And it all starts, even if it's just $83.33 a month, for that foundation to start being created. And by the way, you don't know those first 5 or 10 years that you could have just waited. I'll wait till later to start. If instead you do it now, you might have just walked in to one of the greatest 5 or 10 years in stock market history, and you might have missed it. And there's another thing that you might have missed. You might have missed 5 or 10 years of the worst market in stock market history. And you guys say, well, I wouldn't want to be there in a bad market. Yes, you do want to be there, because that means that as the market maybe is struggling and is down, your money is buying more shares than when the market is up. So whether the market goes up or the market goes down, those early years, it's beneficial to you for the long term.
So your number 2 is save early versus waiting to get started. And that's to take advantage of compound interest over time that can result in hundreds of thousands of dollars a year, as you said.
Yeah. Well,
years down the line.
Can I give you one example?
Sure.
Because many of the people that we're talking to right now, David, are going to have a family one of these days, and they're going to have a choice to make. This is $1 million choice as a parent. If you put away $365 a year for your child for the first 21 years, and then you let them take over from there and do it until they're 65, that's the family tradition that you're going to establish. If you get a 10% compound rate of return on that, which is a market rate of return, that's not a miracle that could happen over a long period of time. You could have $2+ million in that portfolio by the time the child is 65. If you wait until they are 10, you will have more than $1 million less. That extra $3,650 in those first 10 years turns out to be worth hundreds and hundreds of thousands of dollars later in that child's life. So whether it's for the newborn that you're getting them started or yourself you're getting started, start as early as you can.
For most people, starting early means once they start making money, probably in their early 20s. And I usually advocate whatever it is you can, like $100 a month, if you can, something, $50, because more importantly than the actual dollar amount, which is not insignificant, even a small amount, as we just discussed, but it's the habit and believing that you can grow your wealth. And even if it's a small trend line up and to the right over time, just seeing that trend line go up, it does something mentally and emotionally, like knowing like I could be okay. And then you start running different calculators and you're like, oh my gosh, if I just upped it by 5%, holy hell, look what happens in 20 years. So I think it's a huge thing. Just get started, no matter how small, but set that reminder 6 months from now on your calendar or your alarm or whatever it is to ping you to say, hey, go take a look. Yeah. If you haven't missed the money, up it by 1% or 2% or 3% or whatever it is. And I think it's also important for us to make a distinction between save and invest. Right now, we're talking about saving and investing, even though we're talking about save early. We really mean save and invest early, not just save into a savings account that's getting you a partial or percentage return. That's not what we're talking about here. Putting it under your mattress is not going to make you rich.
No.
So don't misunderstand. We're talking about saving and investing.
And there's a huge fork in the road. It's the biggest fork you're going to face in your lifetime. And that is the decision to either invest for the long term, because we are talking long-term money, not saving for a vacation next summer. The decision to either put your money into bonds or to put that money into stocks. And this is the third $1 million decision, but it's not just a $1 million decision. It's a millions of dollars decision, because let me just give you a couple of historical numbers. We cannot tell you about the future, but we can tell you a lot about the past. And what we know is we have the numbers going back almost 100 years that show you what would you have made if you had put your money into bonds, understanding that if you put your money into a bond, you are loaning somebody money. You are giving them under basically a contract. You are giving them money that they are going to pay you interest, and they say, I guarantee to pay you back over 5 years or 10 years, whatever that bond, whatever it's set up to work as in terms of how long and how much the interest is. But it's a guarantee. And when you get and then make an investment where somebody says, I guarantee I will give you money, it's not going to be a big return because there's no risk theoretically. Now, I'm not talking about loaning money to one of your kids or a friend. I'm talking about the government or a large
The risk then goes way up.
That's
Yes.
right. That's right. So what do we know? If you had invested in, and there are many kinds of government bonds, but there's one that's a very common bond. It has compounded over the last 96 years at about 5%, sometimes a little more, sometimes a little less. But $100 invested in 1928, when this study started, has grown to a little over $2,000. Now, the problem with that is that inflation would have eaten up virtually almost all of what you made. And so your buying power would virtually be zero. You would just simply be getting your money back, but when you went to spend it, it didn't buy anything. On the other hand, if you went the path of stocks, where, by the way, you don't get a guarantee. You buy a share in a company. You can buy, in fact, you can buy less than one share in that company, but you own a percentage of that company. It may be a very small percentage of that company, but it's a legitimate ownership. And for the person who has $1 million in that company, yes, they're going to make more than you will because they own more shares than you do. But the percentage return will be exactly the same, regardless of whether it's for $1 or $1 million. The beauty, well, first of all, let me talk what's not beautiful. What's not beautiful is the stock market, unlike the bond market, is not stable. The stock market, in fact, there was one day back in 1987, the stock market went down 22% in one day. During the Depression, it went down 80%. So there'll be times, not very many of them historically, where the market will not perform well. And in fact, you will lose money. If you just looked at the years, about 1 out of 4 years, you'll lose money. 3 out of 4 years, you'll make money. But that $100 in an index, a group of stocks that represent the 500 largest public corporations in the U.S., that $100 investment today would be worth almost $1 million. So you are standing at a fork in the road where if you take the one direction, you will make almost nothing after inflation. If you go the other direction, the history based on investing almost like any multimillionaire would invest, because you can literally, as we'll find out, own mutual funds that own all 500 companies, and you can put $50 in and you're going to own little pieces of all those companies. It's an amazing opportunity to participate in the growth of our country and these corporations. But you give up the 1 day or the 1 year stability to know it's always going to be there. You don't want that stability, because without accepting that lack of stability short term, you do not get the long-term return. But I can tell you this. I can tell you that the worst 40 years that index ever had was a gain of about 9% a year. The worst. And the best was 12.5. So those are huge multi-million-dollar kinds of return.
And you don't say that to say that bonds are entirely a bad thing. And you've gone through the risk-reward trade-off between the two. But in the context of asset allocation, how do you recommend investors balance stock versus bonds, particular as age progresses?
Well, I'm almost 81. My wife and I have half of our investments in bonds, and we have half of our investments in stocks, the very kinds of things that I talk about in the book and we'll talk about here today. And the reason I'm half in bonds is because I've now built the pot of gold to retire on, and I want to balance some growth for the future along with some defense for the present, because we're living off this to cover our cost of living, which is the reason it's so important that we all invest, is because this society used to have pensions, not for everybody, but for most people today. Very few people have anything more than Social Security or the money they put aside in an IRA or a 401k or some sort of a formal investment plan for them for their retirement. So bonds are not for young people. I don't want a 21 or a 25. I don't even want a 35-year-old having bonds in their portfolio if they don't have to. Now, we may talk about some cases where you have to, but if you don't have to, because remember, when the market goes down, it's true the bonds would stabilize the portfolio, but you want the opportunity to buy the cheaper shares. And bonds keep you from buying the cheaper shares. So young people in their 20s and 30s, I think basically all equities, plenty of time to get conservative later in your life. And it will be important to do that.
Speaking of equities, and you mentioned pensions and 401ks and some of that you get through your employer. And one thing that I've noticed is what's offered to many employees is individual stock purchases of that company's stock over time. Yeah. So then the individual thinks they're getting a good deal, which they might be getting it at somewhat of a discounted rate as, compared to the masses. But then that gets you into the number 4, one stock versus many stocks predicament.
Yes.
And we're talking about investing in many stocks instead of only a few or one. If you really like your company, you just get that new job and they offer a discount on the stock, and you're like, yeah, let me put it all in there. That's a huge no. Why is diversifying across many stocks so important compared to investing in a single stock? And could you share some real world examples of why this strategy works?
Oh, sure. No problem. The bottom line is this, that when you put your money into the stock market, whether you buy one company or you buy 1,000 companies, what the academics tell us is the expected return, because we don't know what the return is going to be. A lot of people, for example, David, where people they lost their life savings, they worked for a company called Enron, and the company even encouraged them to put all of their savings in their 401k into the company's stock. And they did that. I grew up most of my life in Seattle. And in Seattle, we had Washington Mutual. Their line was friend of the family. Well, it turns out they weren't a friend of the family because they went belly up. But a lot of people who worked at Washington Mutual also went belly up because they were putting their money into this company that was doing so well until it didn't. And it's important to note that over half of the companies that ever were public did not make it. Over half. So with that in mind, I don't want you to be in one company. I want you to treat yourself like a multimillionaire on day one. And I want to go back to what those academics tell us. They tell us the expected rate of one stock is the return of the market. If the market has a 10% return expectation, the expectation for the individual stock would theoretically be 10%. But in the case of the one stock, it can go belly up, bankrupt, worth nothing. On the other hand, when you own 500 or 1,000 companies, if one goes belly up, it doesn't put you out of business. And so when we look at this return of 10% from the S&P 500 over almost 100 years, that includes the companies that didn't make it. And so you want to go, as far as I'm concerned, if you're going to get 10% with one company or 1,000, I want you to go there with 1,000 because your risk of going out of business is virtually zero. I mean, you'd have to have a collapse of the entire economy, virtually zero.
Mm-hmm. So right now we've got the Magnificent Seven, and we got Tesla and Apple and many others. But I'm seeing similar ideas and trends where people are just putting money into these particular stocks and without maximizing their other broad market index investments first. It's interesting how history might repeat itself here.
It's
maybe not in the too distant future.
That is the history of investing, and I've been around it since 1963. And people chase performance. They love to get into things that have been doing well lately. This herd mentality is a bias that costs people tons of money. Just by the way, the same thing those people do when the market goes over the cliff. They jump out together. I mean, they're a herd on the way up and they're a herd on the way down. And there is not one expert that will tell you that the best way to invest is to try to be with the herd, because there is a right way to invest based on the past. And it's important for all of us, David and myself and everybody in this industry, to be upfront. There is no risk in the past. We always know what worked and what didn't. And so when we come here and say, please don't put your money into lottery tickets, well, somebody who just won the lottery would laugh at us. What do you mean don't buy a lottery ticket? I would not be worth $500 million today if I hadn't bought that $2 ticket. But we have to make the decisions and do the educating based on what is probably most likely to work for you. And I'm just telling you, many over few. And the good news is you don't have to sacrifice the return one bit.
So number 4 was one stock versus many stocks. Invest as many stocks instead of only a few. And that transitions us kind of nice into number 5, which is, how do you do that? Many investors wonder whether to pick individual stocks, because that's kind of exciting to do. And I agree, it's kind of exciting. Or do you hire a mutual fund manager? What's your take on DIY investing versus professional management, Paul?
Well, if I had any belief that an individual, other than simply by a random event, would do better than the market, I'd say go to it. If I knew a way, but I don't know a way. And virtually everybody in the industry who speaks from a point of view of a fiduciary will say that, but there is an industry. We talk about the capitalistic system wanting to strip us of our money. Well, in a way, a lot of the people in the business who are advocating their services are advocating services that are proven to cost people. Anybody who is recommending you start trading the market as a way to make a living, these are people who are simply making a living off of convincing people to trade the market so they can get the piece of the action from these people who falsely believe that they are going to beat the market. Virtually everybody of repute will say, if you could just be the market, if you could just do as well as the market, you would have a phenomenal return. In fact, if you could simply over your lifetime get the market return and no more, you would probably be in the top 5 or 10% of all investors. Now, that seems strange because I'm sure some people are thinking, wait a minute, aren't there smart people that can do better than the market? Yeah, there are smart people who try. There are people who make $500,000 a year, $1 million a year, millions a year. How do they make it? Managing other people's money, okay?
Fees.
And they get it in the fees. Yeah. And how many of them are able to be as good as the market? About 1 out of 5 or 1 out of 20 historically, to which you might say, fine, tell me the person who's the 1 out of 5 or the 1 out of 10, and I'll put my money with them. the reality is nobody knows how to choose that individual ahead of time, which of course is going to lead us pretty directly to the kind of mutual fund we should all have.
But before we do that, let me ask you about, right now we're talking about individuals who actively manage funds and ourselves. So it's like individuals versus professionals.
Yeah.
But now there's this thing called robo-advisors and AI. Have you seen anything out there that proves or shows, or we just don't have the data yet to indicate that they can beat the market?
In a sense, the portfolios that we offer people to do on their own from our website, they are the equivalent of a robo-advisor. It's just that we're not in the business of making money off of people. So what we do is we tell you exactly the kind of portfolio that a robo-advisor would put you into.
Okay.
Now, but there's a myth in the question that comes out of that question you're asking. Can those robo-advisors or the people who have free portfolios for people to do on their own, can they do better than the S&P 500? Let's call that the market, the 10% return. Absolutely. And you don't need a robo-advisor to get it. All you need to do is to put a portfolio together so that it gives you exposure to more than just the large companies. Because smaller companies make more money. Value companies make more money. There are a number of ways that mutual funds, kinds of equity asset classes, and that's what the robo-advisors are counting on, are those very classes. But David, they're not beating the market. They are accessing another part of the market.
Paul, I ask you that question very specifically so that we can get some foreshadowing for some points later in this conversation. I know it's coming. You walked right into it. Couldn't have planned it better. Let's get to number 6. Actively managed funds versus index funds. Choosing index funds instead of actively managed funds. Why? The debate between actively managed funds versus index funds is ongoing, especially if you frequent any of the traditional financial websites or media outlets. Why do you believe index funds are a better choice for most investors?
Well, if we are giving you honest advice, and our advice is based on one thing, it is that what is the probability of success? What we know about actively managed funds, it's not a pretty picture. As a matter of fact, it's almost, no matter what corner you look in, it's dark. For example, actively managed funds, their only reason to be in existence in theory is to do better than the market. Because we know that when you buy invest in an index fund, that you are expecting to get the market return less some very, very, very low. In fact, in some cases, zero expense. Okay. So what are they going to do to try to beat the market? Well, the first thing they do is they're going to jump at some rate in and out of the market. And they are going to try to be in the good stocks when they're going up and get out of them and be in other good stocks when those good stocks start going down, because they are actively trying to do better than the market itself on a pure buy and hold basis. Now, what do we know of that outcome? We know of that outcome that those people, on average, make less than the market because there's a cost to trading in and out. And then there's the cost of hiring the people to do the trading in and out. And then there are the extra taxes that need to be paid because the people were buying and selling. And then they don't have much diversification. They might have 100 companies where the index has 500. So you're taking less risk with the index. You're paying less in taxes with the index. You're paying less in expenses with the index. And everything says you are probably going to get a better rate of return. Will somebody beat the market over 20 years? Yeah, about 1 out of 10 or 1 out of 20, depending on the equity asset class, the types of stocks that we're talking about. But does anybody know ahead of time how to pick the ones that do better? And the answer is nobody knows. And so if nobody knows, wouldn't you rather just say, hey, if I could be in the top 10% for the rest of my career, count me in. And of course, the industry is going to say, wait, come here. I think we're going to do better this next 10 years. Yeah, we didn't have a great 10 years, but we got some new ideas and we think we can make you more money. Don't believe it. And it's a hard thing to say because these are good people just trying to do a day's work and be paid for it. The problem is they're on your payroll and you don't have to pay them 1%. You can pay them 1/10 of 1% or 1/20th of 1%, or as I said, some cases, 0. And it all stays with you and your family.
So the pros of index fund investing, I'm going to do a quick list and you can jump in, add or concur or disagree. Lower fees, consistent outperformance of actively managed funds, broad diversification, transparency and simplicity, tax efficiency, eliminates manager risk because they don't have to figure out what they're going to buy. They just buy the index.
Yep.
And you don't need to predict market trends. You don't have to wonder if they're going to jump on the next trend. Better for long-term investors, as history indicates at least.
Yep.
And data-driven results, meaning that history also shows that they outperform, at 10%, 8 to 10, 12, whatever percent it is, over the course since 1929. And then reduced emotional investing. It's automatic. Yes. So you don't have any person saying, I need to buy this, and then trading in and out, and then adding trading costs, because even if you're not the one trading it, you end up paying the cost to trade all of those individual stocks when somebody thinks it's a good idea to buy the next big thing. Agree?
And I agree. I want to add one.
Okay.
It's in there. It's in between the lines. And that is the probability of the investor staying the course. You mentioned the emotional. It's about trust. And if, for example, you go through a period like 2000 through 2009, and the market didn't do well, it lost at a compounded negative 1% a year. Did people panic that were in the S&P 500? No, they did not, because they understood it's made up of the 500 largest companies, and they believed it still had a good future. On the other hand, if an active manager had done poorly, you're not sure whether when the market turns around and goes back up that they're going to do well. And I just want to emphasize this potential cost, because there's a disaster waiting to happen to some people who use actively managed funds. The people who do the studies of the active managed funds and the indexes, they track the top 25%, the next 25, the third 25, and the fourth 25. So they know that 25% of the active managers are way down. They could be 2-3% a year below the index itself. So you take the risk with active managers by chance of ending up right at the bottom of all of the funds in the industry. And you could say, well, what are the likelihood of that? Well, let me tell you about Bill Miller. Bill Miller beat the S&P 500 for 15 years in a row. Legg Mason Value Trust, 15 years. And what happened then? The money just rolled in because people thought they had found a magic man. For the next 10 years, he was in the lowest 1% of all advisors. That is the risk that you take. And you can't know. I mean, just like we can't know what the market's going to do in the future. We can't say whether big will beat small or value beat growth or US beat. We can't know, but we can take steps to protect ourselves against what I will call the catastrophic. And active managers have that risk built into the work that they do.
One thing that really jumps out, and it happened about 2 minutes ago, is I've been doing this. I think this is probably going to be like the 37th or 38th, episode of this podcast. One of the themes that keeps coming up is this, and it came up right now. It's coming up with you before, and it's come up with J.L. Collins, and it's come up with Christine Benz, and it's come up with Dr. William Bernstein. All amazingly smart, wise people with time in this space and a history of helping people and living through it all. And that theme is the investment strategy that is best for the person is the one that they are going to stick to.
Yeah, it's an interesting topic, David. It's complex because if we go by the people should just do what they'll stay the course with. If they have chosen actively managed funds, let's say they're in an IRA and they can change without a tax on their profits or whatever. If they have funds that have high expenses, if they have funds that are not well diversified, if they have funds that are market timing inside of them, and how can we tell that when they're doing that? Is because we can track that they go to cash from time to time. And so they are not really buy and hold, but there are all these little possible things that we could be critical of if we wanted to call it that. Mm-hmm. The question is for all of us, how far do we go to control the things that are obviously hurting you, like paying high expenses versus low expenses? If 0.5% translates over a lifetime to an extra $1 million or $1.5 million, then I'm just saying, if you're going to keep doing, particularly for young people, if you're going to keep paying expenses that are high, I just want you to know that your kids are going to have less, your charities are going to have less from everything we know about the past. And so at what point can we say, good enough? You don't need to go any further, because I have living 40 feet above me in another condo, Bill Bernstein. So here I am. He's a neighbor, and he's a great guy, and he's a smart guy.
Sure is.
Do we agree totally on the perfect asset allocation? Not exactly. Would either one be okay? I'm sure either one would be okay. But I do have to say that if you listen to Bill Bernstein and Christine Benz and me and J.L. Collins, you're not going to be in actively managed funds. Mm-hmm. And how many experts does it need to say to take that position to have somebody believe, now, wait a minute, God, this guy who sold me these belongs to the church. I trust him, and our kids are playing baseball together, and all of these reasons why that's where I should be.
I know. And it's funny you say that. I hear that all the time. Yeah.
And our view is that I am investing for my wife and for me. I am investing to help Western Washington University. I just got my first thing. What do they call it when you get it's the Merriman Financial Literacy Program.
Nice.
At Western Washington University.
Now, is that actually like a yellow or off-white, or is it filled up with like protein powder drink?
Yeah, but this is water. Okay. I don't do anything fancy. That would be healthy. But what I'm saying is, I'm dedicated to these people and helping the students at that university. Every one of them is going to be coming through a program where they are going to be exposed. When I die, I want to be able to leave lots of money to that project and to my kids. And so why would I want to pay somebody an expense for which they are rewarding their kids that we know is not adding value to the return?
Yeah.
I'm sorry to go off on that, but
nope,
I'm
good with it.
It's a hard.
Let's do it.
Where do you stop being an evangelist and just say, okay, do what you want?
No. Okay.
What's the next one?
Now, that alone, we could have probably gone on a rant for like 45 minutes, and I'm ready to do it. But that'll be another episode where we just go off the rails. Let's do that. That'll be fun.
By the way, I have a book that's entitled Get smart or get screwed, how to select the best and get the most out of your advisor.
But you could change that to like dating, couldn't you?
I'll try that. If we get more people to read it, probably. But anyway.
So, Paul, I think these first 6 that we talked about, and I'm going to quickly go over the first 6, what they were. Number 1 was save versus spend. Number 2 was save early versus waiting to get started. Number 3 was stocks versus bonds. Number 4 was one stock versus many stocks. Number 5 was you select the companies versus hiring a mutual fund. Number 6 was actively managed funds versus index funds. So I think those first 6, like if anybody were to like not even read or explore the next 6 that we're going to talk about, I think they would actually be about 80% okay, if not better. Like I think that's the bulk. But at least the next 3, which are more nuanced, they are adding. So number 7 is going to be adding large cap value. Number 8 is going to be adding small cap blend.
Yeah.
And number 9 is going to be add small cap value. I just want the listener to understand that this is like slightly next level stuff.
Well, you know something? You're right, David. I would say if there was one more that's really, really a big deal, and we can come back to these that are more nuanced and meaningful, the target date fund. That is big.
That is big. And we are going to be talking about that.
Okay.
At number 11, I think. So we will get to that.
Okay, let's talk about those 3.
So once the individual has a solid foundation, which we talked about in those first 6, then you start looking for minor things that you might want to tweak, which understandably does take very slightly more effort, which you might be able to combat my claim on that a little bit. And I hope that you do. But number 7 is, let me find it on my list, add large cap value. You emphasize the importance of adding large cap value stocks.
Yep.
Why are these stocks crucial for a well-diversified portfolio? And how does that fit into what we've already talked about?
You know what I'd like you to let me do is to talk about 7, the 3 of them, those 3 asset classes. And because I think if I could offer one really simple thing to do that will have a huge impact over a lifetime, is to combine those 3 with the S&P 500. And there is what we call a quilt chart that actually shows the return of the market 1 year at a time since 1928. And it shows each year how did the S&P 500, big, mostly growth companies, how did it do compared to large value companies that are out of favor, compared to small growth-like companies and small value out of favor companies. So the question is, how did they do each individually, and what would happen if you put 25% each into those 4 different equity asset classes? So basically, large growth, large value, small growth, small value. It turns out that the S&P 500 compounded at 10 over the period 1928 to 2023. That's with dividends reinvested. That's with no taxes. And the large cap value did about 11, and the smaller companies that were growth did about 12, and the smaller companies that were value oriented, not as popular, did about 13. If you took the average of those 4, it was 11.8%. Okay? Now, I want you to picture the volatility because this is really important. If I could tell you that there was a way that you might get almost 2% more per year in that part of your portfolio for the rest of your life, and that it would be less volatile than the S&P 500, the number one most revered, and that more people own the S&P 500 or the total market index, which is virtually the same, in the return since 1928, 0.1% difference for 96 years. So it's virtually the same.
But with less risk.
No, not with less risk, with virtually the same risk, because it's being driven by large companies, growth companies. Both of them are. So what we know is that with the average of the four, you make almost 2% better. But if we look at each year, you will see sometimes the S&P 500 is at the top, another year they're at the bottom. They're all over the place. You have no idea what you're going to get. It could be the worst, it could be the best. But the average of the four is never the worst and never the best. It has to be that way. So in 78% of the years, it's right in the middle. Now, that doesn't mean that you're always making money. When all four of them lose money, then you're going to lose money. You're going to lose the average of the four. So you have an investment that is less volatile and produces almost a 2% a year better return. That is golden, and the only reason that it might not happen is because it may be that for the next 96 years, the S&P 500 will be number one every year.
Can I ask for some clarification here?
Sure.
Are you saying that, like, if somebody invested, the performance of the S&P is for at least as far as long as we have data or implied data, if someone was 100% that versus 25%, 25%, 25%, 25%, totaling 100% of their portfolio being in large cap value, large cap growth, small cap value, small cap growth, and those percentages, you're saying that the 100% S&P 500 versus the quarter, and the variation, I'm assuming ETFs or mutual funds, that might be a next question, that performance is roughly the same with less volatility if you go with the 4-4-4-4?
It's 1.8% better. It's 1.8%. It's 11.8% versus 10 for the S&P 500. Now, here's the thing that's interesting, is that what you're doing is you're doing the very thing that people are doing with the S&P 500. You're building a diversified portfolio, and you have some really risky companies inside of that S&P 500. But in this case, the diversified portfolio is about four very different equity asset classes. There are years that between the best performance and the worst performance of those four equity asset classes, there is a 30% difference in return.
What does the risk profile look like one versus the other?
Well, it depends on how do you measure risk. If you measure risk on standard deviation, it's a little more risky than the S&P 500. Okay. If you did it based on just the volatility, remember, one investment is always in the middle. It's never up here, never down there. So it isn't bouncing around as wildly as all of the others, which is what diversification is about and what the academics tell us. Once you have like the S&P 500, to add another 100 similar kind of companies, that doesn't change anything. You want to change things? You diversify amongst different equity asset classes. And that's what that large value and small blend is about. But the bottom line is that there is a higher return, potentially, because we can't put all of the weasel language we have to use about the future. The future will be different than the past. We can't guarantee anything. Well, let me tell you what I can guarantee. I can guarantee that the future will look like the past. I absolutely believe the future will look like the past. I have no idea what sequence it will come in. Nobody can know what the sequence will be. But if I can say I believe that if there have been bad years in the past, there will be bad years in the future. Most of your viewers do not know the following information, David, and that is from 1939 to 1938, the compound rate of return was better than the compound rate of return of the S&P 500 from 2000 to 2009. And that is before you apply inflation to the outcome. Some people, they criticize me for years saying, why do you go back and show all that stuff from 1929? Doesn't mean anything. Those times are never going to happen again. They did happen again. They will happen again. The reasons they happen are different. Today in the market, small cap value off the charts. I mean, it had a great day. What does that mean? Nothing. It doesn't mean anything. Yeah. But
a couple of days ago they didn't.
Pardon?
A couple of days ago they didn't.
Exactly.
Yeah.
And so what I know is, I know that from 1975 to 2014, the S&P, the small cap value index, compounded at almost 20%. But since then, it's underperformed the S&P 500. And people say, oh my God, small cap value is dead. It's never going to do it. That's just the nature of how markets work. And if you don't understand and get to know the history, you start questioning what you believe.
Yeah, and I do know that the whole, it's also interesting. Like if you take like a 30,000 foot view, this really almost doesn't matter. And I hate to say that because I know it's such a big point of what you advocate, but like the small cap value portion. But if you were to do it to the masses, like just get the 80% your solution. Most people are going to be pretty good. But in these niches, we talk about small cap value versus not, and then the returns of the last 15 years versus before, and why Paul Merriman thinks small cap value is important versus why Carson Jeske thinks Paul Merriman's wrong, and why you should not count on small cap value because of the most recent underperformance as compared to other. So I get it, but which I honestly like objectively, it's a great position to be in. If you're arguing these little nuanced points, we're good. You're golden. If you're listening to this and that's where you're at in the weeds with this, your future financial future is going to be just fine. You're doing great.
But you make a good point, David, and that is, we have a table that shows the S&P 500 with 10% in small cap value and 90% in the S&P 500. Fine. It adds 0.3% to your return, and you would not even we didn't even see any difference in the return at the end of the year. And so it's not about turning everything upside down, but maybe it's worth turning a little bit upside down.
So Paul, how I see the value of these last three that we just talked about, which we did combine them, 7 through 9, we combined, which was 7 was
large cap value.
8 was
small cap
blend. And 9 is small cap value.
Yes, and the blend, it has some value in it, but it's mostly growth.
So if I were going to take this conversation and say the so what, what's the so what of this conversation? Somebody listening to this probably already understands of like the buy and hold, VTSEX or whatever, the broad market index fund. Let's do that. Maybe they got a bond fund. Maybe they've got some other fund that's giving them some kind of delta. But as compared to I say vanilla, it's still pretty rock solid, is like the VTSEX or the broad market S&P 500 and just buy and hold strategy. So what a person listening to this would do is say they just heard Paul Merriman, who is brilliant, has decades of experience, and the soul of a person who just wants to help and do good out in the world, wants your best interest, has your best interest at heart. He says this. So if I say, okay, I'm on board, what I need to do is go back to my Vanguard or my Fidelity or my 401k and look and to see if there are those other three.
We have Vanguard recommendations.
Okay.
We have ETF recommendations. And for most people, if they can, it's better to get into the exchange traded funds than the mutual funds.
That's what I'm hearing.
And we have a gentleman, Chris Pedersen, who works every 2 years to update the ETF recommendations based on what we call best in class, because there are dozens and dozens of small cap value ETFs. Why would one likely be better than most of the other? And so we are working to try to help people make that decision because we don't believe they'll make it on their own. But we have Vanguard, we have Fidelity, we have T. Rowe Price, we have Schwab, free portfolios. You just go to our website, go to portfolios, And in some cases, David, in order to do this, to add a little, for example, small cap value, they're going to have to do it in an IRA because they don't have it available inside of their 401k.
Yeah, good point.
So it's and I must say that we will get back to the target date fund, because in many cases the target date fund is way better than just putting your money into the total market index.
All right. So in the show notes, we will have the link to the information that has the best in class funds for these 4 funds that we just talked about that represent the large cap value, large cap growth, and small cap value and small cap growth.
And the quilt charts. You'll love those if you haven't seen them.
So Paul, this kind of gets us to the next level of more like psychology and behavioral finance. Number 10, market timing versus buy and hold. Market timing versus buy and hold is a topic, I would say, much debated. People who like understand a lot of what we just talked about as far as like what history proves that you can't beat the market and things like that. And that's kind of an extension of that. Why do you advocate for buy and hold over market timing? Because I will say I am even guilty of thinking I can time the market at times.
Of course.
And while it doesn't derail my long-term plan, I sure would have much more money if I just didn't try to time the market, admittedly.
Right. And can you say that you have stopped doing that?
No.
See, that's the problem. You know better. This is like me with my dinner. I can't wait for dinner tonight. And I know I'm going to do things I shouldn't do. So let me talk about the problem I have with the market timing and buy and hold. I'm looking for $1 million decisions. And I can tell you that lots of people have left millions of dollars on the table and they don't even know it. Because like they got out in January, February, March of 2008 or 2009. A lot of people bailed out, just couldn't take it anymore. It's what I call the ICSIA timing strategy. I can't stand it anymore. And they jump out. And I know some of those people who have not gotten back in. What did that cost them? And now there are people who will accept one kind of market timing, and that's dollar cost averaging. Because, and we talk about that, that's one of the other decisions that can be made, is to just every month buy the shares. When the value of the shares are down, you get more shares. When the value of the shares is up, you get fewer shares. Mm-hmm. And so both that and the timing, it's a little more difficult to make it for sure $1 million decision. But I can tell you that $1 million mistakes are made all the time because people think linearly. We have a free book. The title is Spending Your Way to Wealth. And in the back of that book is a quick outline of Daniel Kahneman's Thinking Fast and Slow, which is about the biases that hurt us, in many cases financially. And one of those biases is we think linearly. And when something is going down, our brain says, it's going down forever. I'm going broke. These stocks are going to be worth nothing, and I got to stop the bleeding right now. And so you lock in your mistake. And then you got the problem of when do you get back in? And the reason I don't believe in market timing is because there is no more difficult strategy than market timing, because you have to make the decision to get out. You have to make the decision to get in. You have to be willing to take multiple losing trades, bad trades in a row if you're going to be a real market timer. And you can't be second guessing the systems. Almost everybody who tries market timing second guesses the system. So I like buy and hold because the probabilities of success, if you could just keep your hands off of the investments. By the way, if you've made bad investments, I want you to get rid of them. But if you can keep your hands off of the good investments you've made, I think you'll do better.
Yeah, I look back, one of the biggest one, and the crazy thing is I was actually really proud of my decision in the 07-08 crash. It Well, I didn't have a lot of money back then. I maybe had like $42,000 in my thrift savings plan, and it was in stocks or whatever. And then the February of the year, I moved it over to the G fund, which is the government security, zero risk. You're going to get 1 to 2 to maybe even 3.
Yep.
I don't think 10%.
Yep.
I was like, yeah. And then I watched the market crash. And with market timing, you got to be right twice.
Yep.
I was right once. I was wrong the second time. I waited way too long to get back in.
How long?
I don't know, maybe like 18 months, 2 years.
Yeah.
Maybe longer. I can't remember exactly.
Yeah.
But it cost me thousands and thousands and thousands of dollars. And the crazy thing is, I worked with somebody, and she was a civilian, and she worked. I don't think I can get arrested for this. I'm retired, all good. But she asked me, because people knew I liked money back then, and I knew. And this is like, I think all of us struggle with this. One thing to get on a podcast or a blog and say this, and it's another thing to do it in your own. So closing that gap over time, as I think, is a real skill for people who are in it as much as we are. But a woman worked with me, and she showed me her TSP balance, and she's like, "What do you think I should do?" I said, "Just leave it there.
Yeah,
just leave it there where it's at."
See, it's
and
easier.
A few years later, she thanked me, even though I took a hit in my portfolio, and she did great.
It's easier to be a teacher. And by the way, a few minutes ago, you gave me credit for being brilliant. I am not brilliant. I know how to read what the academics write. You do not have to be brilliant to do that. And all of the work that we are doing is really just trying to take what we know has come from the academic community and package it in a way that people will learn it. It's like our quilt chart. You will see investing like you've never seen it before. I promise. Doesn't mean that you'll be any better at it, but it is a good way of learning. And that's what we're working on, is finding better ways of helping people learn. All right, what do we got next?
Target date funds. Let's start with just defining what they are, how they fit into what we've talked about already, and maybe the bridge between behavioral finance of why this might be the best thing for the masses rather than people who are, like me and you, talking about this stuff all the time.
Well, the title I have when I talk about the target date funds is America's #1 retirement investment. There is no question in my mind that this is the greatest investment ever developed. And it's made up of if you do it right, of two other great investments. One is the mutual fund. So you get the mutual fund in your portfolio. 2, you get index funds. Not all of the target date funds are based on index funds, but the ones that I want people to look at and put their money into are in index funds, so that underneath the umbrella that is going to be developed for you will be index mutual funds. But what this fund does that no other fund does is you tell it when you want to retire. So it knows that if you say you want to retire in 2065, you're somebody getting started in whatever you're doing in terms of investing. You're a younger person. Now, you could be a 65-year-old who wanted to have the combination of stocks and bonds in a 2065 portfolio. So you can fool the target date fund if you want to, but it knows who it's working for. And it knows the people in this group, they should be all or almost all in equities. And then as they age, they'll probably stay about the same, maybe a little bit of fixed income and mostly equities until about 40. And then they start transitioning slowly. So by the time you're 65 or 70, you're going to be probably 50% in equities and 50% in fixed income. The fixed income there to stabilize, because basically what they're trying to do is when you are young, you have very little financial capital, but you have a ton of personal capital. You are worth a lot because you got 40 years of hard, smart work ahead of you, or if you're in the FIRE movement, 10 or 15, whatever it is, but you have got the personal finance. And so you want to take the risk in the early years. But when you retire, you no longer you can't make any money anymore. Your personal capital is of no value. So now you have to depend on this money that you have in that target date fund to live on. Now, the reason I love them is because 90% of the folks out there are not qualified don't make the right decision. In fact, we have a study, Wharton has a study on the decisions that were made by people who didn't use a target date fund but could have. The target date fund is doing the very thing that most people want. Please take care of me. Know who I am and what I want to achieve, and manage my money. And by the way, manage it for very little, like 800s of 1%, less than 1/10 of 1%, to have your money managed professionally, truly professionally, conservatively, by the way, too conservative for me personally, and I'll talk about that in a second, but that could be the only decision you ever have to make as an investor. And that decision is, I'm going to invest in my 401k, which is where these target dates are going to be found, we hope. And I am going to continue to increase the amount. I'm going to do my part. They're going to do their part. When I get to retirement, they will know that I'm about the retirement age. But I ask the question, will you continue to manage the money for me until I die? And they say, yes, we'll do that for the same 8/100ths of 1%. As a matter of fact, by the time you get there, it'll probably be 4/100ths of 1% because the prices keep coming down. And so it gives people everything they need. Now, the only problem, from my view, is there's virtually no exposure to small cap value. Okay? So what can you do about that? You can put 90% of your money into a target date fund and 10 or 20% into small cap value. End of story for the rest of your life. And it will probably give you an extra 0.5 to 1% a year for the rest of your life. Oh, I forgot the study. It's important. Wharton looked at 1.2 million accounts, 401k accounts through Vanguard. They looked at the people who had no target date funds versus those that were all in target date funds. And the expected difference in return, 2.3% a year. Now think about that. You can let somebody else do it. And unless you are super smart and you know about all this stuff and know how to control your emotions, you are likely to be doing 2.3%. I'm looking for 0.5% to add $1 million. 2.3%, I'm getting at least 4 extra 0.5% from what I would likely have gotten if I had done it on my own, thinking I was smarter than the market.
So if somebody's listening to this, they just heard us talk about the buy and hold. They just heard us talk about the 4 different funds, and now they're hearing us talk about target date funds. How do you balance all that information? Is this where the conversation divides into the people who are going to want to actively manage their own? When I say actively manage their own, I don't mean like hire active funds, but like be an active participant in their own portfolio management.
You hit it.
Versus those who just want to fire and forget. So, and you're saying this is where the conversation diverges from the do-it-yourselfers who actually has like an inkling at least to learn about this and has the ability to go in and the wherewithal to go in once or twice a year to rebalance their portfolio in these 4 funds or 1 fund or whatever their strategy is.
That is, you're exactly right, David. And the fact is, our work is generally of interest to people, a lot of engineers, a lot of mathematicians. I mean, they like evidence-based decision making, and they know I'm not trying to sell them anything. And so the bottom line is, yes, it is for the people who want to be do-it-yourself investors. There are a lot of people out there paying somebody 1% to manage their money amongst a bunch of mutual funds. What if you saw all the numbers and you came to the conclusion that if you did something so simple as the 4 funds, that you could eliminate that 1% for the rest of your life? It's big money. Now, some people say, oh, but that means I have to be responsible. Well, let me tell you how responsible those people who are serving you can be. They can be very irresponsible. You may go in and say, I want to sell everything. And they will tell you, listen, don't worry, it always comes back. I mean, they give you this, stay the course. They're trying to do the right
Stay
thing.
their course.
Yeah, that's exactly right.
Yeah.
Their course. And many times these people are putting people into actively managed funds with high expenses and a load up front. I mean, all these things that are not in the best interest.
Do they still have loaded funds? I know it was a huge thing like 20 years ago. Is that still a thing?
Of course, yeah.
Oh, yeah. If anybody's listening to this, just run the opposite direction. And if anybody ever says loaded funds, period.
Well, here's the sales pitch on that, so they'll understand it. You're only paying me 5.5 or 5.75% one time. I am helping you invest in this fund. I have found this fund for you and our research department.
Thank you so much.
But understand what it's really costing you.
Yeah.
Instead of $10,000 going to work, it's $9,425, which means that $575 is now going to compound somewhere else at 10% a year. And what that really means is you just locked yourself in to an extra cost of 0.5% for a lower return of 0.5% for the rest of your life. It isn't just the $575. It is, what is that 5-7? If you double your money every 7 years at 10% approximately, and you would double that 5 times, that becomes a bigger and bigger number. And your kids would prefer that you be smart about that because you're going to leave them more money.
Yeah, Paul, I think expenses cannot be understated, cannot be overstated,
right.
In this context. So if somebody's got a 401k and they open up their list of options, they will very likely see many of the types of funds that we talked about. Honestly, I don't know if any ETFs are offered in 401ks. That's a different conversation. Maybe I'm not sure.
That's starting to happen, I understand. But
okay. And then we've got target date funds. So you'll likely have some target date funds offered in your 401k. And then you'll have at least some of the other options that we discussed earlier. So take a look at your 401k, see what's offered. If you have no idea, I believe most people don't even know what they're invested in their 401k. So please go take a look at your 401k, log on, find your login information or contact HR to figure out your login information, to figure out what you're even invested in. Then come back and re-listen to this in the context of knowing what you see is available for you. And then make some decisions based on what Paul's talked about, how you may want to reallocate some of your holdings. But about expenses, they matter. And how you can tell is that's the expense ratio. And honestly, that's just like that's like the main expense that I know to look for. But there are some that I don't even know to look for, but you have to look on your prospectus and stuff, which is kind of like next level. But if your expense ratio is low, that's probably a good sign that you're going to be doing okay. When I say low, I mean like VTSAX is 0.04. Fidelity has some 0%. Yep. And there's some pros and cons there too, from what I understand. But still, it seems like it's pretty legit.
It's legit.
Yeah. And the link that we're going to have below is going to link to some best in class ETFs. So if a solo 401k or in your control of your brokerage account or however you want to, however you manage your funds or your net worth, take a look at the expense ratios. And I don't know these funds that Paul's going to link to, but take a look. If they're 0.04 or below, they're probably great. Like it's not worth saying, oh, this one's 0.02 versus 0.04. That's negligible in my opinion. It's more important about like your overall strategy and find something that works for you. Paul, we're rounding up on the last, number 12, I believe.
Target date funds, I think was the last thing, right?
Yeah, we just talked about target date funds. That was number 11. And number 12 is invest in a Roth IRA versus traditional IRA.
Yes.
Now, this is a big thing. Like,
yes.
So people decide when people go into the workforce, they're like 401k or 401k. But what's even crazy for me to understand is people don't know that they can go on their own and then start a separate IRA. And that IRA can be characterized as Roth or traditional. So why would one want to invest in one over the other, and what do they invest in?
So in my own case, almost all of my IRAs are regular. And the reason being is
I'm
because
sorry, when you say regular, you mean traditional?
traditional, because they're all the charities are the recipient of all of my IRAs when I die. Most of that going to Western Washington University for their program. But the reason I'm a great advocate for Roth 401ks or Roth IRAs is because when you make that investment, you do not get a refund. If you had invested in a regular 401k or a regular IRA, a traditional IRA, you would have gotten a refund, and you would have taken that refund and likely spent it on something fun. Now, I don't know that it will be, but I would say that what you should theoretically be doing if you wanted to be Roth-like is you would reinvest the refund back into the IRA. But here's the deal with the Roth IRA. You are going to grow tax-free, not tax-deferred. And when you get to retirement, you will take that money out without having to pay any taxes. Now, that means a lot to me because when I came into the industry, or when I first started investing, the marginal tax rate for people's earnings was 90%, I believe, on everything over $100,000. Now, $100,000 was a lot of money, but 90%. And when I started as a stockbroker in 1966, it was down to 70%. We have no idea what the tax rates are going to be 20, 30, 40, 50 years from now. There's lots of reasons to believe they could be higher. And it's not impossible that somebody might not come up with a flat tax that would solve the problem, in which case it could be lower. So we don't know for sure what tax rates will be, but I do know this, that when you do the Roth, you get the free growth instead of tax-deferred growth. And when you take the money out, you don't have to pay any tax. And when your kids inherit it, they don't have to pay any tax. They have to take the money out within 10 years, but basically they can take it out without tax. And you don't get a chance to take the refund and go out and have a party. Instead, you are buying the right with that money. So you're really, in a sense, investing more. But part of what you're really investing is that you're paying taxes up front that theoretically you would have 30, 40, 50 years from now. So it's always tough when we do things that mean that the payoff doesn't come for a long time. But this is another one of those cases. And also, I would also add, David, to your expenses. A lot of people leave out the tax costs of mutual funds. But you can go to Morningstar, and there's a place where you can see what the tax impact is of your fund. And typically, index funds have a cost of about 0.5% a year in taxable events. Actively managed funds of the same kind cost on average about 1.5%. So there is right there to pick up that cost for the rest of your life because you wanted to pay somebody a load and then you wanted to get a lower rate of return because it was actively managed. I mean, and set yourself up for having to figure out whether to fire the people later. God, the return on an education in this area is so big. Don't miss the chance.
Return on the education in this area.
It's huge.
The problem is getting people to want to be educated about it. That's the challenge.
Yeah, but they have to be able to picture the prize. If when I eat when I shouldn't and eat what I shouldn't, I know what's going on in my brain. I'm picturing how happy I'm going to be. And then I'm going to settle into my comfortable chair and watch some talking heads. And it's just going to be relaxing as opposed to doing something that doesn't include all of that stuff that feels good. And that's what you're asking people to do, is to figure out a way to sacrifice for the future. But obviously, a lot of people are doing it. And one thing we should note is 401k plans used to make people opt in to start the process. Then they started requiring people to opt out. When they opted in, it was something like 20% of the people or 25% of the people would invest. When they had to opt out, something like 83% of the people invested.
Yeah, I was very happy. That is one of the rare cases where blanket change actually, was a great thing. Yeah.
You think that was true with seatbelts?
Well, I know my son puts on a seatbelt every time I get in without me yelling at him too much. So
that's great.
I'm glad that transition happened.
You know something there, when you think about this list of $1 million decisions, smoking or not smoking, is that $1 million decision? Having kids or not? It's $1 million decision. We make them all the time. Getting couples therapy or not? It's $1 million decision. And the problem is we don't have somebody to guide us through all these little forks in the road, because there's not much money to be made off of us at the very point that you should be getting the right lessons. How do I make a bunch of money off of a 21-year-old kid who can hardly put together a $50 a month? And so I got to figure out something to sell them that I can make a decent return on quickly and then get on to the next client. It's too bad, but that's the way it is, which is why these people have to want to get the education. And there are now 25 states that require high school, a 6-month personal finance course. 25 states. That is absolutely huge.
Yeah, Paul, I want to jump back really quick, and then we're going to wrap this up. I want to jump back to the Roth IRA. And this is kind of something that I didn't realize earlier. And if I did, I would have definitely, in my own experience, I used my Roth as not like a piggy bank, but as almost like an emergency fund. And 15 years ago or 10 years ago, I would have advocated that for other people because of the ability to take money, your contributions out without penalty. However, this was the trade-off, and now I regret it, and I would advise differently for others. So if someone's listening to this right now, they're very likely going to be on the up and up. You're learning about nuances. Honestly, much of what we talked about today was fairly basic once you get into this world. But I'm 46. Paul, you're slightly more mature than me. But a lot of people listen to this, maybe they're way younger, and they don't see that when you're 62, 60, 70, and you see that these huge accounts, some are taxable, some are not. Social Security comes into play, pensions come into play. And then you're starting to balance that taxable income versus living expense and how to play that whole game. If you're in that situation, the Roth adds an ability to live on expenses and gives you more flexibility when you're playing that taxable game. I don't want to get into that too much right now. That honestly could be taxes and retirement should be a huge, that could be a different episode. But what I did not know is, and I didn't think about it, it's not that I couldn't understand it. It's just it didn't click to me, and it didn't matter to me at that time. But as I started closing in on those years, I'm like, what if I'd have just done that? It would have given me a little bit more flexibility going forward. So having that Roth might even cause you to delay Social Security a little bit, because it might reduce your taxable income, because withdrawals from your Roth at that time, especially contributions and earnings, are not taxable. So it opens up more options as you go forward to have a significant balance in your Roth.
Yeah, and I really think one of my responsibilities over the little time that I have left in doing this is to try to give people information, and there are lots of people who do this, on how to find a good hourly advisor that you could just buy a couple of hours of time. And you might go in once a year and do that. You don't have to pay somebody 1% a year to get good professional advice. But it isn't something that you can just go to the Yellow Pages and pick up the phone and call one. You got to figure out. I just, in my newsletter, and we have a newsletter with about 44,000 people that we go out every week with something. But today I talked about an advisor back in New York who I just think is terrific. And he charges a really fair fee, and he's really smart, and he's really committed to doing good for people. He'd make a whale of a lot more money if he would charge people on assets under management. But instead, he wants to do what he thinks is the right thing to do. The good news is a relative handful of people are going to find him. And then he'll be booked, and he'll have his book of business, and he won't be able to do stuff like our firm. We would just add another certified financial planner once you get to a certain size, and you grow and you grow. And but when you're an hourly person, you are choosing to make less money, but do more good, possibly. For a lot of people who know how to use you.
Well, Paul, you've done a whole lot of good in your years.
Thanks.
And
thank you.
Who knows why paths cross in life, but I'm so fortunate that my path crossed with yours, or yours with mine, or however it all lined up. And I thank you so much, not only for this conversation, sharing your 12 $1 million ideas, but all the wisdom that you've gained throughout your career. And I know this won't be the last time we talk. And I've actually had people who listen to this podcast and watch the YouTube, and they're like, "Can you just get him back on every quarter? I just want to hear him. You're all right, but let's get Paul back on."
Well, there's a lot of good people you could have on that would be more than happy to come work with you. You're doing a terrific job, and you make people feel welcome, and you give them time to share, and that's golden. So let's hope we change some lives, and that we will do it again in the future. Okay?
Yes, we will. It is truly a pleasure knowing you, and I thank you for your friendship.
Betcha.
And we'll do it again very, very soon.
All right, buddy. Take care.
And thank you all for watching and listening.